What is up, everybody? This is Stock Market Education, and today we're going to be talking about a stock that I've already put about $1,100 into, and I'm considering putting another $2,000 in, and I wanted to share with you guys and see what your thoughts and opinions were about it. If you're new to the channel, we break down and analyze individual stocks as well as explore the markets as a whole, and my goal is to shorten the research time for my subscribers for any individual stock. However, I stress that no one should buy stocks without doing their own strenuous research. With that being said, let's get into it. Now, we're in a recession for the first time in over a decade, and I thought to myself, how can I profit from these large fluctuations? Well, which companies took advantage of the 2008 recession to buy up low-priced assets? And that led me to the company that I just started buying earlier this week called Blackstone, ticker symbol BX, for an average cost of $49.33. And Blackstone is an alternative asset management firm that specializes in 4 different areas: hedge funds, real estate, credit, and private equity. And if we look at their numbers, we can see that they have a market cap of $61.67 billion. And on Yahoo Finance, they show a PE ratio of 271. However, that's wrong. Their actual PE is about 17.5. And every now and then, Yahoo Finance's numbers are skewed, so it is important to double check them with other sources. Blackstone pays a dividend of $2.44 per share at about 4.75%, and they shouldn't have any problem paying out their dividend because they have a payout ratio of 63%. If we take a look at their income statement, we can see that their total revenues increased from $4.3 billion all the way up to $7.4 billion for a percentage increase of 69%, giggity. And net income increased from about $1 billion to about $2 billion for a percentage increase of 97%. These percentage increases give us the evidence we need to be able to say that Blackstone is one of the fastest growing alternative asset firms in the sector. Compared to the S&P 500, we can see that Blackstone has nearly tripled compared to the S&P 500's returns. Most of Blackstone's potent growth awoke in 2019, and if we take a look at Blackstone's stock price from 2019, we can see that they had an incredible year, almost up 100%. And you're probably asking why. Well, it's because they clicked the like button and subscribed to the YouTube channel. It was also because they converted from a master limited partnership to a regular C corporation. And what does that mean in English? Well, master limited partnerships have certain tax forms that went along with the partnerships on behalf of the buyer. As a result, only 1/3 of buyers could or would buy master limited partnerships. Once they got rid of that tax form, they went on to operate like a regular corporation, and all of a sudden, Blackstone had 3 times the buying power. Investment firms need firepower during times of economic downturn in terms of cash to be able to take advantage of undervalued assets. In their most recent 8K, CEO Stephen Schwarzman stated that they have insane amounts of capital, saying, "We entered this crisis in a position of great strength, having recently completed a 2-year fundraising cycle of nearly $250 billion. With ample capital reserves, long-term fund structures, and over $150 billion of dry powder capital." Dry powder capital is just a slang term used for liquid cash, and the report would later go on to say that they're looking to deploy that cash into undervalued companies. And keep in mind that Blackstone only has a market cap of $61.67 billion, and they operate about $570 billion worth of assets. In late 2019, Blackstone and MGM entered a joint venture deal worth $4.25 billion for Bellagio, where MGM will manage the property and Blackstone sits back and collects the rent, which was agreed to be about $245 million annually because they purchased the land that Bellagio is sitting on, ultimately resulting in a stable cash flow from MGM. And let's go back even further. In 2004, There was a fund management group who decided to build a new integrated resort property on the Las Vegas Strip, but had to default on a major loan from Deutsche Bank during the financial crisis in 2008, and over the next 6 years, Deutsche Bank would begin to funnel $3.9 billion into the project, only to find that they weren't able to make a profit. That's when Blackstone stepped in as a buyer and took major advantage of the situation, bought the property literally for cents on the dollar, about $1.73 billion for an integrated resort that Deutsche Bank poured almost $4 billion into. And with this economic downturn we're seeing right now with hospitality, we're going to be seeing Blackstone making more acquisitions in this industry, just like how they were back in 2008. Just today, Blackstone acquired a 10% stake worth $360 million for Crown, the largest casino operator in Australia. This is important because Crown has been on life support since the shutdown and left them desperate for cash, and it appears that Blackstone is looking to increase their stake in Crown over time, possibly buying them out, which will be a brilliant long-term investment at these current price levels since Crown's stock price is down 21% since February. So we have Blackstone, an alternative investment company who's loaded up with liquid cash during an economic downturn and is looking to deploy that cash into long-term investments. The risk factors with Blackstone are mostly laws and regulations based. For example, any changes involved with the current tax laws, changes in privacy laws could increase compliance costs. Ultimately, new regulations create uncertainty for asset management firms as far as their growth strategies, as well as an increase in interest rates. Thank you guys for watching the video. Click the thumbs up and subscribe if you enjoyed this video, and have a great day. Bye.